Good afternoon, ladies and gentlemen. It's truly a pleasure to be attending this conference organized by Edelweiss. Vikas, thank you so much for giving us this opportunity. I've been asked to talk about insurance coming of age and what insurance will look like in 2025. The problem is once you get listed, your mouth is sealed almost completely. You can't talk much. So let me just try to give a more provocative view of what I believe can happen in the insurance industry in the next 5 to 7 years. And I think the title captures it very, very well. If you look at the number of insurance companies which are listed in India, and that has happened over the last 15 months or so, there are 6 companies which are listed directly. There are at least 3 companies which have indirect listing in the insurance space. So today you have 9 entities in India which have come about in the last 18 months or so, where you can actually access the Indian insurance market and the opportunities therein. Good to see a combination of both the life and the non-life side. And we are also aware that a couple of other companies are trying to get listed in a short span of time. So very quickly, I'm going to talk about 3 things. A little bit of what is the economic rationale for why insurance industry has a long runway for growth. A little bit of some data on India life insurance itself and our performance. So if you look at, obviously this was quoted by the person who introduced me also, that with the high GDP outlook, favorable demographics, and structural underpenetration, Indian insurance industry should do well. I think we have sold that story since the Indian insurance was, at least the Indian insurance was privatized in 2000. I think the Indian insurance industry sold these 3 words for at least 15 years of their journey and did not have much to show for it. And they always talked about high GDP outlook and favorable demographics and the fact that we are underpenetrated. And that fact still remains true, because in spite of almost 18 years of journey of the Indian insurance space since post-privatization, the numbers still look very, very low. So if you look at our GDP on a per purchasing power parity basis, we are ranked number 3. Demographics are quite favorable. And demographics are favorable not only for the young age, but I think in the next 5 to 7 years, you will also see a pretty large chunk of population shift to age 60 and above. So while on one side people talk about demographic dividend, the other trend which is people don't talk about enough is that there is a huge portion of the population, almost 25%, for almost every 1,000 people, around 260 people need to be supported in the next 5 to 7 years. So you are also seeing a pretty big chunk of population shift to post-retirement. And at that point in time, they also need insurance products, whatever they might be. And annuity is one of them. So we are seeing clearly a demographic dividend. The housing savings rate is gradually moving up, especially towards financial savings, helped by demonetization, helped by the fact that the government is coming after black money in a big way, helped by the fact that the physical assets are not giving the return which people are used to getting in the past. So the financial savings rate has moved up to 43%, and I have some data later on which I'll share with you. We remain underpenetrated, 2.7%, and we'll show you how over the last 10 years this number has really not moved much. The average insurance density remains, again, abysmally low in comparison to the other markets. And there is a huge high protection gap in India, which is, this was a study which was done quite some time back in 2014, where the estimate was that India has about $8.5 billion of a protection gap in terms of revenue numbers, which needs to be fulfilled because India is underprotected. So just putting it in terms of comparisons, if you look at the penetration, we are way below the markets around the world. If you look at density, we are again way below some of the comparable markets around the world. Protection gap, we are the highest. The penetration numbers have moved up and down, but within a particular zone. They have not really kind of got established in a particular trend line. And given all of that, it is obviously quite apparent that the runway for growth remains very, very large. The second reason why I believe people underestimate the runway for growth, so there is one side where the economic data is saying, yes, Indian insurance opportunity is huge. The numbers have really not moved up enough over the last 18, 17 years of the journey of post-privatization. And it is obvious that at some stage this will take off. And some of the numbers I'll show, the industry growth rate, seem to indicate that the growth rate is taking off. The second part, which is less well understood, is that please understand, and I'll show you data on that also, that the industry has been, especially at the life insurance side, has been dominated by LIC forever. So the larger players in the life insurance space have been gaining market share at the cost of LIC and the smaller players over the last 5 to 7 years. And that's also a clear trend. So it is not only the GDP and the economic data which will drive growth for the industry at a certain rate, but for the larger players, there is another factor at play which can drive growth in a very, very different way. And the third fact, which is underestimated, which is where the profits of the industry could come from in a significant manner. So it's not only the growth rate on the top line, but also in terms of bottom line, is this huge protection gap. Now, people quote various data, and I'll come to that in a minute, but so if you look at just the overall financial savings, the numbers are moving up. They were 43% last year with the data which is available. And you will see that the share of insurance has gone up, but it has been 25% also in the past. It's not that, our share is disproportionately high. We have a reasonable share of the market. As the share of financial savings grows, it's only imperative that the share of life insurance will also grow over a period of time. Over and above that, if, as I was quoting the data to you, if you look at the evolution of the life insurance industry, you will see that it has gone up and down. The first 7 years were all about jostling for market share amongst private players, spend a lot of money, about 35,000 crores of capital was brought in, a lot of money was spent. And LIC itself will admit that they got, if someone spent 100 rupees, they got 70 rupees of benefit because of all the spend that was happening. There was a well-known brand name. As people became aware of insurance, they turned towards LIC and bought insurance. So the first 7 years, while a lot of money was spent, and yes, the growth rates were high, LIC had a disproportionate share of the market, continued to enjoy a disproportionate share of the market, though they lost some market share. Then we had these 5 or 6 years in between where new regulations had to be brought in, which obviously were required at that point in time, because the first 7 years were all about not only jostling for market share, but a lot of mis-selling, a lot of the wrong products were being sold. So there was a settling down of the industry where the men from the boys were separated and there was no growth to show for. I think there was a completely different period in the life insurance industry. And the last 4 years, you have seen this growth come back in a very, very significant manner. The second point to look at and understand here is that while LIC started in 2000 with, on an individual WRP basis, 100% market share, at the end of the first 7 or 8 years, the market share on the individual WRP basis went down to 49%. As the regulator brought in new regulations, their market share went back up to 63%. Over the last 4 years of the growth of the private sector space, market share of LIC for the first 9 months of this financial year on an individual WRP basis has fallen to 43.6%. So what it really shows is that definitely the private sector or the private insurers are gaining market share from LIC in this new avatar of insurance, post all the changes which have been brought about by the regulator. One important point to understand. Second important point to understand is that after this change of 6 years which was brought in by the regulator, the reason why life insurance industry suffered was that many of our products were not competitive. And I'm not talking about the latest budget. Even before this latest budget, over the last 4 years, as insurance companies have gained scale, as they've been able to lower their operating costs, as they've been able to build their distribution channels, we today have products which are at least on the investments and savings space as competitive as other financial asset classes. That fact is less understood and appreciated. And I'm not talking about the changes which the budget has brought about on long-term capital gains tax, which actually puts ULIP at an advantage as long as the customer is willing to stay with you for 5 years. So you have economic data which is working in your favor. You have a situation where the private sector is gaining market share at the cost of the largest player. You, for the first time, have products which are competitive against all the other financial asset classes, and your share of financial savings is only 25%, so you potentially can gain more share over a period of time, and this is before this budgetary change. The third fact, which is, again, less well understood, is, and I talked to you about the market share and what is happening in terms of numbers. not only the large private sector players are gaining at the cost of LIC, they are gaining share from the other smaller players. So what this data shows is that over a period of time, I'm not able to read very well here, that the share of the top 7 players has gone up gradually, slowly, in terms of individual WRP to 78%. If I was to do this chart, because everyone does not declare their profitability, if I was to do this chart on profits, this number could reach maybe more than 100%. So not only are the top players gaining share at the cost of LIC, they are gaining share at the cost of smaller players also. So if we believe that the runway for growth is solid, we have seen growth for the last 4 years, you have better products and you are gaining market share on both the sides. And that's an important fact to understand. And then we have this under-penetrated protection market, which I think at least HDFC Life has shown what is possible from a protection perspective. And we believe there are some other things also possible. I'll talk about it later. So from just economic fundamentals perspective, and I want to emphasize this point, runway for growth is long. Investment and savings products for insurance, our estimators account for more than 95% of premium income on an individual WRP basis, if not more. So 95% of your income, where it is coming from, your products are competitive against all financial asset classes. You are, as a company, or if you are one of the top 7 players, you're gaining market share from both the sides, and you have a protection space which is under-penetrated. That's the story as far as coming of age is concerned. And if we can understand that, then very quickly the next question that is worth asking is, who are the players who potentially can have the platform and have the ability to execute on this opportunity so they can continue to get a disproportionate share of this runway for growth in the future? And that begs some more questions, which I'll again talk about. So a little bit of HDFC Life itself, and I will go to the questions in a minute. We have around 11,000, we are ranked number 3 if you cut the data across individual WRP, overall premium, etc., and the private sector space. We are represented through 11,200 bank branches. We have close to 16,000 employees, 139 bank insurance partners, 21 new ecosystem partners. We have about 70,000 plus agents, and we have 414 branches of our own. That fact is well known. I don't want to spend too much time on this. The key question on execution, which people are underestimating, is on how insurance will get sold in the future. Because we all know, if you look at the data on the large private sector players, which I just showed, you'll very quickly see that all the players here, who are listed on the right-hand side, are invariably have a pretty strong bank insurance distribution franchise, or they're part of a group, a bank insurance group. So the question to ask is that, will this change over a period of time? If I was to project 5 to 7 years down the line, what would be the share of bank insurance? If you were a company which was thinking 5 to 10 years ahead, what would you like this share to be? How would you go and find distribution channels which are more retail-based, where your reliance on some large bank insurance distribution partner is reduced to a great extent, which you can say that these channels are my own and I can actually distribute insurance products in a cheap way? Because the biggest threat to us, the traditional players in life insurance, is if there was a player which could come, which could actually have 1/10 the cost, 10 times more customers, and sell at a price which is cheaper than yours because of the cost structure which they have. And we are seeing examples of that come about. There are a couple of companies which are setting up in general insurance space which call themselves actually as digital insurers. We have an example in Policy Bazaar which is actually coming and disrupting the market in a slightly different way. So what are the biggest question I believe in front of the insurance companies for next 7-10 years is, what are the new distribution channels which you can go and capitalize on, and what are you doing about it today? First important question. Second important question is, as multi-tie, because I'm sure some of you will have that question, multi-tie is becoming way of life for some of us, and in the next 5 to 7 years will become way of life for most of us. How will you manage yourself in multi-tie? What will be the differentiators you will create for your bank insurance partner, for the customers of the bank insurance partners, which will allow you to get a disproportionate share of their customer relationships? That's the second question. Third, when we talk about millennials and the fact that their attention span is so much lower, how would you even go and actually connect with them? Question number 4, if banks in general are going to make the customer journey so seamless, in that journey, where will even bank get the time to sell a third-party product like insurance, which is supposed to be a push product? Where is the time? Because I'm sure a lot of us sitting in this room don't even go to a branch anymore. Don't pick up the calls of the RMs when they call us. So how will insurance get sold if that is going to become ubiquitous across a lot of banking customers? Those are the questions which I think HDFC Life started asking 3 years back. And we believe that we are working on various initiatives which will allow us to reimagine insurance as we move forward. Now, I can't talk about every strategy because then people start copying it, but the point here is that what I'm really throwing before you is, when we think about coming of age, this is one of the most important questions the insurance company should be asking of themselves. What will change? And how are you going to execute on that change? And the problem is that because you are in many cases one step removed from the customers, because all 7 of us on the private sector side have large bank insurance relationships, how do you manage this change? So we have thought about, the slide is not really saying anything because we can't say. But we talk about branding and marketing, what we can do on branding and marketing, what we can do on the product innovation side. So one thing we have definitely done is that we have been pioneers in product innovation. We have gone and identified new niche areas. We have come up with products in those niche areas and actually established the market for them. To give you an example, we have just launched, I would say, again, a very innovative product in the marketplace, which is relevant to a lot of the people who might be sitting in the audience, on something called deferred annuity, where if someone is willing to defer their annuity is a very simple product. You pay a sum of money and you get every year a certain amount of income. There are various variants to it. You could get a certain amount of income, and when the person dies, nothing happens. You stop getting that stream of income. There is another version which says that, okay, if you die, the money is returned to you. There's another version which says that if you die, the money continues to come to your wife or your spouse, and when the spouse dies, then the money comes back to you. So there are various versions to it. But it's a pretty simple product. What we have now launched is that if you are willing to defer an annuity for 5 to 10 years, let's say for 10 years, today you could lock in rates of 12.5%, 13% for your and your wife's or your spouse's lifetime. There is no product like this in the marketplace. Now, we have taken 1.5 years. It sounds like a very simple journey, but for us, it has been a 1.5-year journey to launch this product 10 days back. Now, that is innovation. So what we have been doing as, again, reimagining insurance is saying, what are these niche areas which others are not addressing where we could do something? And again, I can't talk about the future, but because you launched it, this is, I guess, the ability of an insurance company to identify these kind of niche areas and launch products which are unique and very, very different. By the way, if you look at the annuity market, LIC, our belief is, has more than 95% of the market. That's a market worth attacking, if you can manage, obviously, your liability and the asset side of this quite well. So, something in that area. Second is on the sales and distribution side. I talked to you about a lot of questions. How will it get sold? How will you reach this new customer? How will you create a journey where the customer is not even interested in talking to you? And what can you do to enable your partners, you can enable your own salespeople to be able to sell insurance in the future? And it cannot come about overnight. You have to start thinking of that. I mean, when we talk about 21 new ecosystem partners, and there are some examples which we have publicly disclosed, but when you go and see the journeys which we are trying to do with them, some of them are very, very basic, but some of them are quite advanced in the way we are thinking about the journey of the future. There are some platforms in these new ecosystem partners where you can actually go and buy insurance instantaneously, where the pricing of that insurance is lower than that of the Pradhan Mantri Jeevan Jyoti Yojana scheme. I mean, everyone thought that PMJJBY scheme, where you pay 340 rupees for 2 lakhs of insurance, is the cheapest out there in the marketplace. There are some ecosystem partners where our price for insurance is even cheaper. It's less than 300 rupees. That's thinking about insurance slightly differently. But it's not as simple as I'm making it out to be, because there is a huge investment in understanding the customer, there is a huge investment in technology, there is a huge investment in being able to underwrite those kind of lives. So it's a journey which takes time to get to a kind of finishing point. We've also worked a lot on these new ways customer are accessing information. So you see a lot of data points below on our social media presence, which obviously the reason we have quoted is because we are number one by a margin in every social media property. And again, this is not today's journey, this is something which we've been working on for the last 4 years. That this is an important area to invest in, because how can we influence the mindset of these new customers in the future, because they've been hearing about HDFC Life continuously. We are trying all kinds of new mediums, and when we're looking at some of these social media properties, we have had some good results. We are also looking at our operations in terms of how we can use technologies to make the whole journey seamless. So while this slide doesn't say much, because I can't say much, but what we really am trying to say is that we in HDFC Life are trying to answer this question. How will insurance get sold in the future, and what we can do today to be a winner 5 to 7 years down the line, which we believe is a very, very important question to ask. And we also believe that the traditional ways of selling insurance is also very, very important. It is also very important to continue to diversify our distribution channels. So we have gone very proactively, and today I have signed up with 139 bank insurance partners. I'd said 21 new ecosystem partners. We have said in our offering document that agency is a big source of growth for us, and we're going to invest it in a big way. That growth has started coming through in this year. We are also investing in direct in a big way, and obviously we have doing a lot on the broker area side also. The distribution mix remains quite stable. We also continue to innovate across our products and distribution. I talked to you about the Click2 series and the new product which we have launched. Apart from that, we have come out with a cardiac care product recently. We have come out with a group health product. It's not the typical group health product which people talk about, where we offer a group health to a company at a ridiculous price and lose money. Our idea behind group health product is we have taken group credit product to the market. Now we are going to combine it with group health product and bring that offering together. We always are way ahead of the space as far as cancer care is concerned. We have also launched a joint combination product with Apollo Munich. It is doing quite well, where people can buy a health and a term product together. So there are a lot of these innovations in the market which, again, no one has done. Other interesting point is that because we have gone in the credit protect space in a big way, and our numbers for the first 9 months show that our credit protect has grown by 57%, the number of lives which we are signing up for. Last year we signed up about 1.9 crore lives. We've already signed 1.9 crore lives in the first 9 months of this year, and they're contributing pretty significant percentage to our overall individual growth. So this is another way we are looking at how we can look at traditional methods of distribution and attack the customer differently. It's very difficult to read the slide from here, but on the key focus areas, we have always talked about improving efficiency in terms of productivity, our average ticket size, and usage of mobility tools. 99% of our policies are originated on our digital platforms today. And by the way, we are gradually closing all the doors. Our salespeople will have no option but to use our digital platforms. We have looked at long-term orientation, so our retail customer base has increased to 5.5 million. Our policy term continues to grow, has reached 14 years. Our share of protection has now gone to 27.3% on a received premium basis for the first 9 months of this year. Comparable numbers are not worth mentioning. We are way, way ahead of the marketplace. We are also looking at enhanced use of, obviously, technology. So in terms of number of policy applications submitted, amount of renewal payment collected, amount of automation, robotics which we are using internally in our systems, how is Salesforce active in our platforms, all the stuff is around ensuring that we can get the benefits of technology in our operations and how we are enabling our Salesforce. Customer satisfaction, we are looking at that also in a very, very big way. Our concept there is, can we serve our customers instantaneously across all the touch points? And we believe that by June of this year, almost 85% of the transactions can be serviced instantaneously across our touch points and our partner touch points. So we are trying to take the journey to a different level. I know I'm running out of time, so we believe economic fundamentals favor us. We believe we have a platform which favors the larger players, and we are one of the 7 players who will benefit from that runway for growth. We have always talked about our balanced business mix and how it allows us to outperform across business cycles. Reimagining insurance is something which I spend a lot of time on. Strong financial performance. So when we talk about our financial performance, we look at 6 or 7 matrices which are important to us. Apart from the margins, which we for the first 9 months of 22.2%, we say that our EVOP should be above 20%. We say our return on equity should be above 25%. We say that we'll manage our solvency margin between 180 to 200%. We are very clear that our persistency level should reach upwards of 85%. So there are these 6, 7 matrices and are embedded, these 6, 7 matrices which we believe are very, very important for us to deliver on a consistent basis. So it's not only about growing faster than the industry, but we believe that 6, 7 matrices also are something we need to be delivered consistently. We have an independent and experienced leadership team, and obviously a pretty reputed board. Let me just stop here and open it up to questions.
Can we have a mic there? There.
Hello. Yeah. You mentioned 2 data points. One is the insurance penetration. I have a question on that. Would you be able to give a rough sketch? What would be the insurance penetration in the top 18, 20 cities and the rest of India?
So I don't have the data off the cuff, but for us, obviously the top 15 cities are contributing a pretty decent portion. But there is a belief somewhere that the private sector is deriving a lot of its growth from the top 15 cities. That's not necessarily true. If I remember the data correctly, more than 65% of our business is coming from outside the top 30 cities, not even top 15. So yes, and as you look at the data points I gave to you, we have 11,200 partner branches of the top 10 bank insurance players we have. A lot of the expansion of these bank insurance players is happening outside of these top 10 cities. So our reach in terms of going to the rural parts of India is increasing manifold year after year. If you look at almost every large MFI, we are working with them today. So I've given you rough cut data, but I do believe that a lot of the growth which is going to come in the future is going to come from cities outside of the top, not even 15, 30.
And the second thing you mentioned about the market share gains between the private sector vis-a-vis LIC. Again, if you can give a sketch between the top 18, 20 cities and the rest of the country.
I don't think we have the data on LIC as to where they get the business from. So I have no clue. But yes, I would estimate that LIC gets a slightly higher portion from their rural business than what we get, because all of us started first in the major metros and then kind of gradually over a period of time expanded. So our market share in the, I guess you call it the metro markets, will be higher than LIC, all the private sector combined, but I don't have the data to be able to give you a confirmed number.
Thanks.
LIC is not listed, they don't reveal enough data. Yeah. But there is an interesting fact, since you mentioned LIC, people don't realize it. If you look at the individual and the group business for private and LIC, the private sector, the group business is almost half that of individual business in terms of the new business they're generating. While for LIC, the group business is 3.5 times that of the individual business. There is a huge amount of, so LIC today is deriving a lot of premium income from the group business. Almost all of it is funded side, which is superannuation, gratuity, leave travel, and stuff like that. So they have a lot of money to invest, but it is coming from spread business. Yes, public sector, and there are a lot of private sector also who have been invested in the LIC for a long period of time. It's not just but yes, it's the public sector units which have a lot of employees, which means that and they've been there for a long period of time, so the amount of gratuity, superannuation, and some of the corpuses are very, very large with the large private sector units, yes. But it is a spread business.
Yeah, just two questions. The first one was on penetration. Penetration numbers haven't really moved too much. So I know you did touch on it fleetingly. But any sense of what can change for these penetration numbers to materially move up or get to the higher end of the band? The second question is just on the ground, there is a sense that a lot of the insurance companies are very focused, at least in their pitches, on the kind of returns their ULIPs and other products are generating. Why do you think there's so much sensitivity to this, given that it is much more of a longer term product? If the pitch is working, then it should be more about longer term protection and saving rather than this pressure on nearer term kind of performance.
So as far as penetration is concerned, obviously it's directly related to the premium income you're generating against GDP. I think as the growth rate has started exceeding 15% for the last 4 years, I'm assuming this year will definitely be more than 15% because we are growing at a rate of close to 25% for the first 9 months. So 4 years of upwards of 15% growth, the penetration numbers obviously have started moving up. And I do believe, given the runway for growth, the penetration numbers should gradually, slowly move up. And they should at least reach the 3.5% in the next couple of years, which we had at once upon a time. As far as the ULIP thing is concerned, you said that why are we pitching returns? We are talking of the Indian consumer here, who's always looking for a return. It might surprise you, but the largest selling annuity product is the product where you actually return the premium. The reason why you buy annuity is to maintain a lifestyle. But even there, the Indian consumer is willing to live with a slightly lower payout every year so that he gets or she gets the money back, which doesn't come to them, because it comes back only when you are dead. So it goes to someone else. But that's the mindset of the Indian customer. So returns are important. Yeah, I know it's a very revealing fact. I mean, you're buying annuity to live a lifestyle, but you still want your money back, which is not going to come to you. So, yes, we are trying to sell a longer story, but if you look at ULIPs, the problem with ULIP as a product, and people talk about profitability of ULIP, is because the mindset is 5 years. And a lot of these salespeople find it easier to say, oh, after 5 years you can take the money away. I think it will take time for people to go beyond 5. And it is happening. As I said, the policy term for us is increasing. But yes, if I was to give you the number in terms of how many years actually they stay around, it is much lesser, but that is also increasing. But slowly, gradually, it is taking time. So a lot of people have this mindset that, oh, I'm making a return, let me take it away. But now with some of the changes being brought about, I do hope that that pitch will change a little bit, but it's a slow, gradual process. Please remember, we are talking about a salesperson who makes the same amount of money you sell. You give someone a pitch that you stay for 5 years, do you stay for 10 years? So it is difficult. Though, to give credit to the insurance sector, they have worked very hard on this. So, and that is evident in the persistency numbers. The persistency numbers, there has been a dramatic change in the persistency of the private sector players over the last 5 years. Dramatic. I mean, just to say, give the 61st month persistency numbers, if I look at the top 4 or 5 players, I mean, we used to be 35% and we were ahead of the market. Now, almost all of us are in the 50 to 60% range. That means on a premium basis, at least you still have 50 to 60% of the money which came in the first year, which was 20s just 5 years back. So it is changing.
Just to continue with the earlier question, insurance is essentially protection business, and to kind of position it as investment products to the customers is in some sense a persistence of the same mis-selling syndrome, which is what landed the industry in trouble during those ULIP days,
Well, please understand that insurance is not just pure protection. Insurance is also ultimately about the only asset class where you can buy products for the long term. I mean, I gave you an example of deferred annuity. If someone, let's say, was to buy at the age of 50, and he and his wife were to survive for the next 30, 40 years, which product gives you that kind of return over such a long period of time and manages the asset and liability? So yes, it is a long-term investment product. As I said, we did a disservice to ourselves in our initial stages of infancy by just going after premium income, and so we've acquired this reputation for mis-selling. But over the last 5 years, things have changed substantially. If things would not have changed, the persistency numbers would have been much worse. So they have improved dramatically. People today are buying insurance for longer tenure, but it's still a journey we are on. It's not done as yet. Please understand that we can do the protection business at the prices at which we are doing today because we have other businesses also to defray our costs. If all the life insurance industry was doing to sell protection, the prices would be 5 times more than what people are paying today. Because ultimately, protection is also a bit of a push product. And it is very important that you have other products which are long-term investment products which you can sell, so they can defray your costs a little bit. So it is important.
And what do you think of the government offered insurance of 2 lakh rupees at a price of 330 rupees per annum? Whether it is working well, and what are the good or not so good aspects of it?
No, I think it was a brilliant scheme. I have to credit the government and look at the way they went about it. And I'm not saying it because it's the current government is in power. They first opened the Jan Dhan accounts. Then to make them active, they said, push the banks to actually go and sell the insurance. Our experience with, and we have sold close to 8.5 lakh PMJJBY kind of schemes based on what our bank insurance partners could do. Others have done much higher. There have some frauds which have happened. Our experience is excellent. We make money on that scheme at that price. But some of the players are there where they have not made money because there have been frauds which have happened. Because government did work very hard to make the whole process very simple. You could actually enroll yourself based on an SMS. You could file a claim on an SMS, get the money on the Jan Dhan account very, very simply. And as I said, we have today launched, some price for, we have priced a product which is even cheaper than that. Because over a period of time, as you've learned from it, we have gained and we have been able to price it cheaper. So it is a great scheme. It not only made the accounts active, it actually provided a first time for the history of India some kind of protection. But 2 lakhs, we all know, is nothing. It's not going to go anywhere. So yes, over a period of time, the onus is on all of us to go and sell 2-3 PMJJBYs equivalent to any family, because 2 lakhs doesn't go anywhere today. By the way, if you look at the data shows that the primary reason why people go below poverty line in India, even they might be above poverty line today, but the primary reason they go below poverty line is because of one medical emergency in the family. And so, a medical emergency today, given the kind of disease all of us, which are there out there, 2 lakhs again is nothing. So that's why I'm saying the potential is huge, huge. It's a question of how do you tap into that need at the right time so that people are willing to put that small amount of money away on a regular basis. And right now, I forgot to mention that, there are various studies which have been done which say that at a per capita GDP of close to, some studies say $3,000, some say $5,000, the need for protection goes through an exponential curve. Because then you have kind of the economy has reached a stage where people, the consumption side of acquiring white goods, certain lifestyle is over. And now you start thinking about maintaining that lifestyle. And that's where the need for protection rises. When we hit that curve, I don't know, but somewhere between $3,000 to $5,000, if to hit that curve, the protection market in India would take off. And if, as a company, you're positioned to capitalize on that flow, because you have a presence and wide distribution arrangements and all of that, yeah, you could go into a different orbit, potentially.
If we take a modest value of the insurable life as a 5 times per capita income, which is roughly about 140,000, so then we take it at about 700,000 rupees all in. And if you talk of a population of 1.3 billion, then we are talking of potential insurable portfolio today on these numbers.
We have to take kids out, but yeah, it's about 700,000 crores, yes. Number is staggering, yes. Numbers are staggering, but numbers are staggering for life insurance, numbers are staggering for health insurance, numbers are staggering. And that's why I said runway for growth. See, earlier there was a model problem in life insurance. That has been fixed. We were as generally, insurance players just going after premium. We didn't have the right product, it was not being sold right. Now, after that 5 years of pain, now we have reached a stage where the model is in place, products are in place, pricing is right, customers' interest is being put at the center of everything. So the runway for growth could be huge. It's a question of how well you execute on that. Absolutely.
And the current size of insurance portfolio is about 110 trillion, I believe.
If you add the renewal premium, it's about 175,000 crores odd.
170.
Yes. But that includes the renewal, yes.
No, I didn't mean annual premium. I meant the total insured portfolio is about 110 trillion.
Yes, approximately.
It's a slightly different space, but I just wanted your thoughts on the health insurance scheme that the government has broadly proposed, and what would you think could be the rub-offs for life insurance? I know it's a very picture thing.
On the face of it, it appears that it's a fixed payout product. Looks like it. Up to 5 lakhs. They talked about a health insurance scheme which will cover certain, kind of diseases up to 5 lakhs. So it is not an indemnity product, which life insurance industry is not allowed in today. I hope they'll allow us in the future. So it looks a fixed payout product, which life insurance can also offer. So we don't know the details, but on the face of it, we are hoping we can offer it. If you look at, there is already a scheme which exists in India, which is called Rashtriya some scheme, and a lot of states have implemented that scheme. Actually, I think Mint had a great article just 2 days back on that, and if you look at the prices which exist for that particular scheme, and invariably the amounts which are covered only up to 30,000 rupees. And the prices vary anywhere between 200 rupees to almost 750 rupees for that scheme. Even if I was to take an average of 400 to 450 rupees for 30,000, and I take it to 5 lakhs, the amount of money you'll require for a scheme up to 5 lakhs is not 1,000 to 1,200, but it looks like more like 5 to 7,000 rupees on the face of it. So we don't know the details of the scheme on one side. We don't know whether we'll be allowed to play in that space. But on the face of it, even if you look at the existing scheme, which is being run by state governments, the pricing which central government has suggested appears to be on the lower side. And by the way, even in the scheme which exists in the state government, it appears that the insurance players are losing money. It appears. So let the government come out and we'll see. It is obviously a huge opportunity. If you want to play in India, you have to go and do something with it, because that's the only way to understand how you can do over a period of time, get your costs right so that you can do a better job. So if you were to ask me today if you're allowed to participate, will we participate? Yes, we'll participate. We have to look at obviously the mechanics of the scheme and how it's going to work, but it's a huge opportunity, and India desperately needs a universal health scheme, which we don't have today. And as I mentioned, people are moving to poverty line because of this medical event. I mean, 5 lakhs is not enough, to be very frank, but you have to start somewhere.
Thank you.
Thank you. Thanks a lot.